Welcome to the Elevar Show. Today I have two very special guests. The first is Ron, the founder of Blue Mountain Financial, and the second is the head ref of the American Christian League, my good friend Kirk. How you doing today, Kirk?
I'm doing fantastic. Happy to be here. I'm super excited about today.
Awesome, awesome. And we have Ron. So Ron, you are the man, the myth, the legend himself. You have graced us with your presence. So tell us a little bit about yourself.
I am. I'm actually the founder of Blue Mountain Financial Group, also a national sales director of Primerica Financial Services. So I've been doing this now, almost 39 years, or almost 40 years, call it, right? Very excited. The thing for me is I got interested, years ago about how money worked because my goal is I wanted to be wealthy, there. But I'm not a smart person. In other words, I graduated with the health and phys ed degree. So guys like me teach people how to play football. I mean, I was good at it. How I got my first job teaching and coaching, there. But when I got the job offer, the first thing I asked the principal is, well, could you give me the names of 4 or 5 teacher coaches who retired from this system wealthy? And he said, I don't know anybody that's wealthy. I said, well, how about you? You're like the principal. You're like one of the highest paid guys here. Are you at least going to be wealthy? And he said, no. I said, I can't spend 5 minutes, there. And I said, well, who are these people? What do they look like? Where do they come from? And then I just started to research about wanting to be a business owner, although through some trials and tribulations, I didn't understand initially that, I thought you either were an employee or you work for or you own the business. I didn't realize that there was a kind of a middle step called self-employed. And because I thought I was a business owner, and I really wasn't. I was really self-employed. I didn't understand the pitfalls. So I had 4 businesses, that I ended up having. And the pitfalls was I got involved with the wrong company. I got around with the wrong product. I got involved in the wrong time. It was the wrong location, so all those pitfalls kept me wandering around. Even though I made a nice 6-figure income, I wasn't on the road to wealth until I actually came here and learned about how money worked.
Very interesting. So we're going to be delving into the depths of investing and especially Ron's philosophy of investing. So I want to get to it. And the first question I have for you is, why invest? And what are the miscalculations people make about investing? Because everyone thinks investing is this some big scheme in which they think about the hedge funds and they think about the traders and they'll think about their 401ks. But when you really dive deep into it with your philosophy, what is investing?
Yeah, well, first of all, the goal is, and just like I almost mentioned earlier, it's about I want to be wealthy. Wealth has to do with your net worth. To be wealthy, it means, according to Schwab's annual wealth survey, to be wealthy, you need a net worth of $2.5 million. And the sad part is only 2% of the country ever get the job done, when they're so the intriguing part is, well, how do you do that? And so one of the first things that I've learned in creating wealth is something called the rule of 72, most powerful, rule of money. That exists. So rate of return obviously is the key to everything, right? So in other words, if you're so they'll see that, they can see that now.
Yep.
Yeah. So now if you look at this, let me give you an example of what you mean, because first thing people say is, well, how did you create wealth? Like, what did you learn? Just give me maybe 1 or 2 small things that you learned that was the biggest keys to it. Well, here it is. This is number 1 right here. The rule of 72 is a simple rule. It says whatever interest rate your money earns, if you divide that into the number 72, that's a mathematical fact to tell you how long it takes your money to double. So here's an example. If you had 10 grand and you put money in a bank, typically a bank will give you about a 3% return on money. That means 3 divides into 72 24 times, right? So 10,000 in 24 years is 20, and 24 more years is 40. So if you say to the average person, well, what would happen if you double the interest rate? What would happen to the money? Logically, people say, well, if you double the interest rate, you would double your money. But it doesn't work like that. Look at how powerful this is. 6 divides into 72 12 times. Now that money's doubling every 12 years. So in 48 years, it's not 80 grand, but 160,000. Look what happens at a 12% return. The first question I ask people all the time is, do you even believe that you can make a 12% return on your money? And the first people say is, no, I don't believe that. I said, well, do you at least believe banks and insurance companies are making 12% on your money? Oh, hell yeah, I know they are. There. So, but look at the difference at 12. Now it's doubling every 6 years. So that $10,000 one-time deposit, there, if you just gave it to the bank because they knew how to make a 12% return and you didn't, they made $2.5 million on your money. Remember, it was your asset. So you only got 40 grand and they kept $2.5 million of your money. And that's a 10,000 one-time deposit. If you put another 10 grand away next year, like you should, that's another $2.5 million in the 49th year. So the question becomes, how many times can you give away $2.5 million and not be broke at retirement?
Now I want to dive deeper into this because in simple terms, what people don't understand is the compound effect. When you start at 10,000 and you double it, you get 20,000.
Yeah.
But the next time you double it, you don't get another 10,000. You get 20 extra on top of that. So now you get to 40.
Right.
Then you get to 80.
Right.
160, 320, 640. So the whole point of compound effect and compound interest is this is the difference with equities. So I want to ask you about now the difference between the equity market, the bond market, and the CD market. Can we go to that?
Yeah, let's take a look at this. Now, let me hit, before I jump off this, you hit a good point. Let me just bring up the same thing. What if you delayed? What if you procrastinated? So people think, well, if I just wait 6 years because I'm a young person, I got to buy a house, I got to get a car, I got to get furniture, whatever the case may be, and you say, I just delayed putting 10 grand away just for a 6-year period. People think, well, I just lost $10,000 because 10 becomes 20. No, you lose the ending doubling period. So waiting 6 years actually cost you $1.2 million. Huge. I just wanted to make sure we bring up that point because procrastination is the biggest killer of your money.
Let's bring it up because take your time on going to the slides because these are some important reference points. Go ahead and show.
Now, the question becomes, people say, well, where do you make 12% return? Well, let's take a look at, obviously, rate of return is the key. So if you're like most people, you're putting money away in a bank. Now, the highest interest rate a bank will pay you is something called the CD. Right now, remember, that's the highest interest rate. If you had money in a money market account, it would pay less than a CD. If you had money in a savings, it pays less than a money market account. If you have money in a checking, it pays less than savings. So the highest interest rate it pays is a CD. And all a CD is a treasury note, bill, or bond. So you can see, I'm going back now 98 years. If you stuck money in a bank, here you can see after taxes and inflation, that's an important thing to remember because if you made a 3.3% return like the CD average for 98 years, do you get to keep all that money? And the answer is no, you don't. There's two things affected. Number one, you have to pay tax on gain. And number two, you have something called inflation. Now, you probably never thought much about inflation until the last couple of years when all the news is about is inflation this and inflation that. So now it's kind of foremost on your mind. But after taxes and inflation, you can see a CD has averaged a minus 0.9% return. So who in God's name would invest money knowing, I'll give you your money for 98 years. And when I say minus 0.9, that doesn't really have an impact as much as when you look at it from a dollar and cents point of view. So in this example, you see, if you gave the bank $10,000 over 98 years after taxes and inflation, what's it worth? Answer, $4,160. Tell me that's not crazy.
And that's with your interest.
That's with interest.
That's not like accounting if you didn't make a penny because of inflation.
And so the first thing I say to people is, why in God's name would you put your money in a guaranteed loss account? Because that's what it is. Because a lot of times people say, well, the reason I put it in the bank because they're giving me a guarantee. And I said, that's correct. You have a guaranteed loss. That's your guarantee, right? So, and I asked, why do you do it? Well, here's what they say. Well, number one, I know where my money is. And then number two, they're guaranteeing. And I say to them, think about the last time you walked into the bank. Do you remember your last time? Was the vault open? And they say, well, the vault was open. I said, wonder why that is. And they say, I don't know. I said, well, let me tell you. Your money's not there. Money sitting in a bank shelf doesn't make the bank money. What are they doing? They're investing it.
Yes,
So
of course.
here's the problem. You're really not an investor. You're a loaner. You're just loaning your money. They're investing it. And where are they putting it? Well, here's the next thing you heard about, bonds. Okay, that's another. So there's basically three big asset classes. One of them is cash. Second is bonds. And take a look at bonds. So after taxes and inflation on the bonds, you're making basically nothing. Nothing. This is the last 98 years. So if you put money in a bond, your $10,000 is worth $10,000 after tax and inflation. And then there's a third class, equity, stock. Okay, so if you take a look at the equity market, you can see the average rate of return 10.4 for the last 98 years after tax and inflation. Now you're making 5.4. But what does that mean in terms of dollars and cents? Well, now if you took 10 grand and you put it in the market, what do you have in 98? 1.6 million. So here's the difference for me. So remember, I'm a phys ed guy. I get hit in the head a lot of times. Maybe that's my problem. But I looked at this and said, why would anybody allocate their money? Because you heard about diversification. Don't put all your eggs in one basket. And what does that mean? And people think, well, I should have some in cash. I should have so much in bonds and so much in stock. And I say, when I first learned this, I said, that's the stupidest thing I've ever heard in my life. Why? Because when bonds go up, stocks go down. When stocks go up, bonds go down. So if you have typically what the industry talks about is a 60-40 model, here, that means your 40% bonds is canceling out your 40% equities. You only have 20% of your money making money.
Yep.
And then you wonder why you can't retire, why the majority of people reach retirement, brokers still working.
That's so true. When I was I remember my first job I took over with a major company, and I had a part-time HR person come to me and say that exact thing. Hey, you have a 401k here. Are you going to go? And I said, well, tell me what's everybody else doing? She said, everybody's going 60-40.
Right.
But think about it. That's what most people are doing nowadays.
Right.
They don't know. They're not educated.
Yeah. So what we really talk about is, so you say, well, how do I invest money then? Well, you want to be 100% equity investor your whole life. But there's 9 baskets of equity. So you're not putting all your eggs in one basket. There's 9 equity baskets. So the philosophy that I live by is I want to be 2/3 growth, 1/3 value, 10 to 15 small, 35 mid.
Do you have a slide on that?
I do. Here's the baskets.
Beautiful. All right, before we get to the baskets, I want to bring up what everyone is thinking, right? The average person now, when they hear investing, they think one word, NVIDIA. Oh, NVIDIA is going high, the AI revolution and all this stuff, right? But the second thing they might think is the S&P 500, because these are the two popular names right now that are booming off, right?
Yeah.
But that is not how to play the game.
No.
The way to play the game is this philosophy right here, and I'm going to let you teach this philosophy for them.
Yeah, because what you have to look at, well, here I'll even step back one slide even further, because when you invest, and so you mentioned a couple of things that were pretty cool. Like number one, the S&P is the benchmark of equities, on there. And the thing of it is, there's so many people that are saying, I'm just going to buy the benchmark. I'm just going to buy an index fund as an example. And the problem with that is right now, when you look at the S&P and you buy the index, 7 companies, they call it the Mag 7. And you mentioned one of them in the video. The problem with that is 35% of the weighted index is basically those 7 companies.
Let's go through them real quick. We got Apple, Amazon, Google, Microsoft, Meta, NVIDIA, and one more, Tesla.
Yeah.
Those are the Mag 7. So go ahead.
And if you look at them, first of all, and remember, that's 35% of the weighted average of the S&P 500. So if you're buying an index, all those companies that you just mentioned are all technology companies. So now you have no diversification. So that's why just buying an index is not a good thing, because you have no diversification now because of that, right there. So what I'm talking about, when you look at the market has 2 ways of making money: dividends and capital appreciation. So you need to make sure that you maximize both of those things when you invest money. So you can see, going all the way back here, here to the 50s, you can see the average return of the market's been about 11, in this case about 11.2%. 7.9 came from capital appreciation, and 3.3 came from dividends. So you got to make sure that you get both. So when you look at this 9 baskets, here they are. So growth is capital appreciation, and then value are dividends. So when you look at the overall return of every one of those style boxes, as a matter of fact, I'll show you one. I don't want to say this is like a little complicated, but there you can see there's the actual returns of each box. So when you look at the market cycles, what, every 5 to 10 years. So you can see when you look at a 10-year returns, a better indicator, you can see growth beats value almost 2 to 1. Then you have to look at it, well, what happens when the market peaks? What happens after the market peaks? How do those categories do? Well, growth beats value almost 2 to 1. Well, how about when the market trough, when it hits its low?
Yep.
What happens after that? Well, growth beats value almost 2 to 1. So my philosophy was, and I'm not managing anyone's money. I have the best brains in America managing money. My job is to manage that philosophy. So that philosophy is I want 2/3 growth, and I want 1/3 value. And then I want to make sure that I have about 10 to 15% small, because one thing about small cap is the only asset class that actually outperforms inflation in every decade. So typically, when I look at someone's portfolio, I see they're just buying the Teslas or the Nvidias or the bigger companies. They have nothing in small cap, so they're not even capturing the total return of the market.
And one more thing on top of that. So another anomaly of this is small caps, right? So a lot of people are big into penny stocks and all that because they want to get rich quick, and that is quite dumb. I'm going to be quite honest with you. But if you look at small caps, we have to realize Apple was once a small cap.
Absolutely.
We have to realize Palantir Technologies was once a small cap. Tesla was a small cap. A lot of these companies that started and even had that big rise in 1999, 1998, before the crash, before the dot-com bubble crash. They were big, they crashed, they became small cap again, and then they rose. So why do I bring that up? Because if you do want to get quite rich, it's the diversification, like you said.
You got to.
But the right diversification, not putting 80% of your money into small cap, but putting a small percentage, maybe 10%, 5%, whatever that be, for the big guys that can one day become a Tesla, that can one day become an Nvidia, and they all started out small caps. Microsoft too.
You're hitting it right on the nose. As a matter of fact, when you just look at this slide here, that gives a little bit more. You can see the key major asset class versus inflation. So you can see that the difference between, if you just put all your money in large cap and you've got $10,000 since 1994, you can see what kind of rate of return are you really making on that money. Well, it's worth $224,000, and small is $227,000. So more. If I show the slide something that's longer, if I hit it on a longer period of time, the difference between small and large over even a greater period of time is even a bigger difference. But again, obviously small cap, you have a little bit more risk on the small cap side. So it's not just about return, it's about risk that you have to take to get the return. So that's why I like that mix, of that, where I have 2/3 growth, 1/3 value, 10, 15 mid, 35 large, 55, or 35 mid, 55 large. I like that philosophy.
So before we get into retirement, because I really would like to get into retirement, can we get into dividends? Do you have a slide on dividends?
You mean the returns of dividends?
Yes.
Well, that's what this one was. So you can see 1/3 of the return is dividends. Now, if you look at, when people look at just the market, there's the total return and the price return. So like we were talking about this earlier, but when you invest and you just buy an index, you're just getting the price return of the market. You're not getting the total return of the market, right? But if you actually get the total return of the market, I don't know if I have that slide, in here. I probably don't. But anyway, if you look at the total return of the market versus the price return, meaning the total return is with the reinvestment of dividends, you're giving up almost 30-40% of the total return, not getting it. And when you just buy the index, you're not getting the dividends.
And the best part about dividends, I understand asset allocation and I understand rotating your money, but there's times where you don't want to rotate your money. And that's where dividends come in, right? Because let's say you want to buy a small cap. Let's say Palantir one day, it was 15 years ago, Palantir was this small stock, and you said to yourself, hey, this looks like it could become something, right? But you don't want to sell anything. You don't want to sell anything. All your stocks are going up and all that. So now the dividends come in. And now you can put those dividends into that small cap that you're thinking of. And I think that's another important philosophy, and especially when you get into retirement. At the end of the day, when you get to retirement, you want those dividends. You don't want to continue selling your stock, right? So can we get into retirement real quick?
Yeah. What do you need on retirement?
So
My favorite topic.
So the most important thing is when you get to retirement, you don't want to just start seeing your money go down. You want your money to sustain, and that what you built so hard to have, you want that to sustain while living on it, right?
Now think about what you just said here, because this is important. This is another reason why I go back to, why do I want to be 100% equity investor my whole life? Think about this. While you were working, your ass was at work and your assets are at work. Okay, now think about it. Now you say some point in time in your life, I want to retire. So now you retired, and that means what? My ass ain't working. Now, the only thing that's working for you is your money. And this is the time most people retire their money by not being, again, 100% equities. They say, oh, equities are risky assets. Risk has to do with length of time money works, not how you invest the money, the length of time money's work. You're going to live in retirement 20, 30 years. Look, here's a great article from ARP. I love this article. It says, live to 100, plan on it. It says Jeannie Clampett was a typical woman of her time, born in Arras, France in 1875. She lived a rather unremarkable life by most accounts, except for one thing. When she died in 1997 at the age of 122, she was on record as the oldest person who ever lived. I just kept getting older. I couldn't help it, she once said. So what does this extraordinary life of this ordinary woman have to do with us today? More than you might think. In her day, living to 100 was extremely rare. But today in the United States, people 100 and over represent the second fastest growing age group in the country.
Wow.
The fastest are people over 85.
Wow.
Many 65-year-olds today will live well into their 90s. Think of it another way. A 10-year-old child today, maybe your grandkid, has a 50% chance of living to 104, and some demographics have even speculated the first person to ever live to 150 is alive today. They're already walking on the planet today. Wow. So this is what we're not prepared for. And so I tell people that you're going to spend more money in retirement than you earned your entire life. And this is what we're not prepared for. This is why 80+% of the people will end up having to go back to work for money, because retirement isn't an age, it's an income stream. And unless you have the money to retire, you can't.
You can't. Very true. So when we talk about, so let's go into retirement real quick. And the point of it is, a lot of people start young, they don't save, they get to that point where they're in their 40s and they start realizing, hey, retirement's coming up, I gotta start saving, but it's too late at that point. And what ends up happening is they put their money together, they invest it, and once they reach retirement age, Social Security isn't paying enough. So they start to eat from that money, they start to sell their equities, sell their bonds, which they shouldn't have, they start to sell it. And their money goes lower and lower and lower until they're living such a mediocre life. So let's get to that real quick.
Look at this. Here's what you're talking about. The earlier you start investing, the easier it is to reach your goals. So you can see if you start saving as a 22-year-old and you say, look, I want $1 million. Because remember, Schwab, there's a great between Vanguard and Fidelity. Vanguard just came out with How America Saves, and Fidelity came out with, well, how much money do you need when you retire? What amount of money is that? So Fidelity says, if you retire at 67, and that's now the full Social Security age to retire, if you retire at 67, how much money do you need? And the answer is 10 times earnings. So let's say you're married, you and your spouse are making $100,000 combined income. 10 times that means you have to have $1 million, saved for retirement. So then Vanguard says, well, how are we doing right now? Well, they came out with How America Saves report, and they say, what does the average 59 to 64-year-old have saved? Remember, these people are just one step away from retirement.
Yeah.
So what is so remember, we need 1 million. What does the average 59 to 64 have say? Answer, $84,714. So you see the big disconnect right there. So what this slide shows is, well, if you start saving at 25, how much money do I got to save? $381 a month. Well, what if I wait now till I'm 35, 10 years later? Well, now it's 820. How about 45, 1920? Well, how about 55 when most people are thinking, crap, I got 10 more years left to go. I want to start saving. What do I have to do? $5,778. So it just becomes impossible. They're realizing I can't put that money away and I'm not going to be able to make it.
Time is your greatest ally. This is what we're seeing.
And this is why I have this other article is, what do working Americans fear more than death? And of course I say, there's not many things I fear more than dying, right? But what do they fear more than death? Answer, retirement. It says right here, it says 61% of working Americans are more afraid of retiring than dying. 64% of fear retiring more than getting divorced. Now tell me that's not absolutely insane.
That is absolutely insane.
Another procrastination slide if you wanted to see that. And that's the one I was telling you earlier about the investor that started putting money away.
Yeah, I think that's the one I remember inherently, because this really shows how important time is. So you can put away how much per month?
Yeah,
7?
so you can see investor A from 22 to 30 put away $7,000 away a year. That's typically a Roth IRA or a traditional IRA account. And then they never saved another penny from 30 to 67. So you can see they put away 56,000 and they have 2.5 million bucks. Investor B, they blew it for the first 8 years. 22 to 30. I got, like I said, I got a house, an apartment, a car, whatever. But then they say, but I'm going to say that they save $7,000 every single year from 30 to 67. So you can see they put away almost 5 times more money and they got less.
And not only that, but investor A only spent 8 years of putting their money away.
Right.
That's it. Just 8 years. That's it.
Right. Correct.
Investor B spent 38 years, so 30 years on top of that to get to where they are, and they had to invest every year.
Right.
And investor A didn't put another penny. So what would have happened if investor A continued to put their money? That wouldn't be 2.5.
Yeah.
That would be something absurd.
Correct.
So that's the philosophy that we're aiming for.
Right.
So what else? What are some other pitfalls that people come into the world of investing that they make? I want to get to this pitfall that we've seen a lot, especially with COVID, with the '08 stock market crash, and this recent tariff issue where people are saying, hey, the market's going to go down. It's not looking good. Hey, the tariffs. Hey, COVID can shut down the world, right? So they've always been wrong. Never have they been right. They've been right for a good 2-3 months, at longest 2-3 years, but they always end up wrong.
Right. Let me hit you with a good one, what you're just saying. So here's the other thing people are thinking. Now they realize, the market has done pretty well this year, on there. So in their mindset, I missed it. That's their mindset. But look at this. And the other thing is, even at the start of the year, let's just play out 2025, just for example, because it's a great indicator. But we just come off 2 straight years of 20+% returns. So last year was 25%. The year before was 26% return. So people say, well, the market can't just keep going up, can it? And the answer is yes, it can. And here's a great slide. You can see on this slide right here.
Slide 22, right?
Yep. And so since 1950, there have been 8 times the S&P gained 20% or more 2 years in a row. Not including 2024 like we were just talking about. What happens the following 12 months? Well, the average rate of return is 12.3% on that money, right? 12.3. So what did you miss? Nothing. But here's the issue. Right now, you hit another point saying we have one of the highest levels of uncertainty happening in our country right now.
Yeah.
So that's what creates fear. But there's actually an index. You can see it right here. It's called the Economic Policy Uncertainty Index. It measures the overall level of the uncertainty about future government policy.
Yep.
So you mentioned tariffs, you mentioned a couple things. So if you look at this now, we have one of the highest periods of uncertainty. You can see the index right now is at 399. Typically anything over 205 means we have a lot of uncertainty. We're at 399, one of the highest ever. But I'm going to tell you, but look what happens from that. Here, look what